Alright guys, so we're going to be talking about negative gearing in investment properties. Okay, so negative gearing is basically where you lose on your property through depreciation and other on-paper losses, and you mitigate those losses with your personal income. Okay, so it reduces your salary, and in turn you pay less tax on that salary. Okay. Now, these depreciation and on-paper losses were brought into the picture around the 80s or 90s, I think, and it was a government incentive purely focused on mum and dad investors. Okay, so just a quick question. If you have a property that costs you $500 per month, so the difference between the rent and the interest is $500 a month, and you have to pay that out of your pocket. How many of those properties can you hold while paying that $500? So the next property you hold is going to cost $500 as well. Now, the answer to that question is not many, and lots of investors run into this problem. They get one investment property, they think, oh, this is great, I'm making a lot of money, and it's only costing me $500 a month. And then they get another one, so it starts costing them $1,000 a month. And all of a sudden, they're losing heaps of cash, and they never get over that 2 or 3 property mark. That's why I think it's about 90% of investors never go over that 2 or 3 investment properties in Australia. There's this huge misconception that earning less money and paying less tax is better than earning more money and paying more tax. If I was to offer you a $30,000 wage and a $100,000 wage, which one would you pick? It's just silly. It's ludicrous that people are even contemplating this. I would always pick the $100,000. Everyone always wants more money. It's just silly. So the issue comes into negative gearing when you're starting to hold 2, 3, 4 properties. Now, when interest rates go up, which they inevitably will, those 2 or 3 or 4 properties are going to start costing you a lot more than what they're already costing you. You have no buffer. You have no safety net. There's nothing there. They're already negative. As soon as they start getting more negative, I hope you've got a lot of cash stashed away. So when you're negatively gearing, you're basically saying that the amount that you lose every single year is going to be less than the amount that the property goes up every single year. So you're basically gambling on the property market and speculating, saying that, yes, the property that I bought is going to go up by more than it's going to cost me to hold it, which is just silly. Well, I don't understand why you would gamble like that. You might as well just go to the casino and put $500,000 on black. You should always base your investment decisions on things that you can measure. You cannot measure what the capital growth is going to be, okay? You just cannot measure it.